I think a lot of people don't realize that investing is a problem that's been solved. We know what the average returns are for equity, for fixed income. We know what inflation looks like over the long haul. We know what the economy broadly does, what the range looks like. The variable, the wild card that we haven't yet solved for is our own behavior. There have been literally thousands of books telling people, here's how to invest. But you could do everything right for years and years and years, and if you just make one or two mistakes, all of that hard work goes out the window. Instead of telling people what to do, let's tell them what not to do. Let me walk you through the biggest traps that you should be aware of that are a danger to your financial well-being. I'm Barry Ritholtz. I'm Chairman and Chief Investment Officer of Ritholtz Wealth Management. My new book is How Not to Invest: The Ideas, Numbers, and Behaviors That Destroy Wealth and How to Avoid Them.
Chapter 1. Why Your Brain Makes You a Bad Investor.
So our brain is this wonderfully evolved organ. It's less than 5% of our body weight. It consumes 20% of our energy. And our big brains are what's helped us essentially dominate the planet. We're social cooperative species. We've evolved and adapted in a very hostile world. And all of the instinctual lessons we've learned over the past 2 million years, all of the way we're wired, are geared to keep us alive in those sort of dangerous circumstances. We're highly attuned to existential threats. We're primed towards action. We tend to notice really bad news and we tend to ignore good news. Why? Because these are all successful survival strategies in the wild. The modern markets have existed for a century or two. There were no municipal bond markets 500 years ago. There were barely equity markets 400 years ago. And so to imagine that 2 million years of evolution somehow prepares you to make decisions. Most of human history, we live 20, 25, 30 years. The idea of having to save and invest for decades in the future, it's just so out of our realm. When we look at how stocks compound, these are just far, far outside of our instinctual experience. We simply have a hard time imagining the way that math works, because exponential math didn't help keep you alive on the savannah. And so we're in a situation where the pharmaceutical companies call this off-label. When they give you a drug for a reason that's not its originally intended purpose. We use our brains off-label. Our brains help keep us alive in a hostile, competitive environment. We're using our brains today to pick stocks, to make asset allocations, to make long-term financial decisions. We simply were never built for this. And so it's in our interest to be thoughtful, to understand why we make these errors, and to try our best to avoid them if we want to succeed in the financial markets. So it's very useful for investors to develop a little bit of a spidey sense, a little bit of a self-awareness as to what's motivating their behavior. So let's talk about how our own cognitive errors and biases lead to bad decision-making when it comes to investing. Let's talk about your limbic system. I want to share a quote from a friend. Dr. William Bernstein is a neurologist and investor, and he said the secret to success in investing is managing your limbic system. That's the part of the brain that's responsible for your fight or flight response. Learn to control your limbic system or else you will die poor. That's a pretty strong statement, but it comes from somebody who studied this over the past few decades. And our inability to manage our emotions, our sense of greed and panic, often leads us to bad decisions. I love the metaphor of Star Trek's Mr. Spock as a metaphor for the stock market. right? Mr. Spock is half Vulcan, half human. One half of his thought process is very logical, but he is also influenced by his emotions, his mother's side of the equation. And when we see the stock market, the Spock market, we see that very often it's some rationality and logic uh, fighting with emotions. Most of the time, the market is fairly rational. It's a future discounting mechanism. It takes stock prices and it says, here's what our best estimates are of future revenue and profits. And that means prices should be somewhere along this line. There are times when the human emotional half intervenes. We see it when markets go vertical, when things get crazy. Think about late 1999 and early 2000 when everybody said, I have to own me some of these .coms and piled in. Sometimes it's to the bottom. Think about March 2009 when people were convinced stocks were going to zero. The credit markets are frozen. The government doesn't know what it's doing. Stocks are going to zero. And the people who capitulated, the people who panic sold, they regretted it when the S&P 500 hit 666 in early March of 2009. That was a reflection of the emotionality of all the people in the market just panicking and fleeing. Here we are, 15 years later, almost 10x higher. Logic tells us that we need to be invested for the long term and also tells us that we have to control our emotions so we don't panic chase stocks up in 2000 and then panic sell stocks at the lows in 2009. So humans evolved emotions as a way to help keep us alive, to keep us alive on the savannah. And so when you have this strong feeling, your natural tendency is to do something about it. If it's fear, well, you want to make the pain go away. You want to stop. What that manifests itself as during a market sell-off is a little bit of panic, and people sell because they're afraid they're going to lose their money. The flip side of that is the greed button. We're jealous. We're envious. We want to have not just money and wealth, but we want to think of ourselves as intelligent and successful. And the way we do that is by buying the stocks that are going up the most. And so when the market is rallying, there is a tendency to stampede into the best performers. You know, the old joke is there's nothing more frustrating than seeing the idiot down the block become rich when you're not. And so FOMO, the fear of missing out, is simply, why didn't I buy Bitcoin at 50 cents? Why aren't I in NVIDIA at $2? Why didn't I buy gold at 500? On and on it goes. The answer is there was no basis, no rational, reasonable basis for you to buy any of those things at those prices. Our emotions get in our way because they're not part of our long-term plan. They're part of our evolutionary wiring, our wetware. Look at what took place during the pandemic with GameStop and Hertz and all of these other companies that skyrocketed in value and then turned around and crashed. These aren't investments. These are speculative bets. Hey, God bless anybody who bought GameStop, at $1 and sold it, 10 or 50 or 100x higher. I'm thrilled for people who do that. The problem is most of us had no reason to think that was any sort of investment. It turned out to be a speculation. Some people made money. A lot of people lost money. But the bottom line is that's not investing. That's speculation. I'm all in favor of setting up a cowboy account. If you like that sort of thing, take 3, 4, 5% of your liquid net worth and put it into a trading account. Have at it. Buy all the Bitcoin and GameStop and stock options you want to trade with, but understand two things. If it works out, well, great. It probably wouldn't have worked out if it was all of your assets. Imagine you have your stock allocation and it's up 2x, 3x, 4x. People start to panic and say, hey, I got to protect these gains instead of investing for the long run. With 2, 3, 4%, you could let that run and it doesn't really matter. It's not going to cause that sort of fear of losing all your money. On the other hand, if it crashes and burns, if it goes to zero, well, thank goodness it was 3% and not your entire portfolio. The advantage of a personal account, a cowboy account, is it doesn't matter how high it goes or how low it goes. If it scratches that itch from me, it forces my big, dumb lizard brain to leave the rest of my money alone.
To be continued.